I've always felt also on the hedge fund side, the nerds are taking over the world, right? It's like the quants that become more and more important. Now the nerds really have superpowers because now I can literally program any business logic into the internet.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. Ruud, thank you so much for joining me today. Super excited to chat with you. All right, Ruud, you are the managing partner at Theta Capital, which is an institutional crypto fund of funds. You guys have over 50 crypto fund investments and now over 1.5 billion in assets under management. And through your funds, I think you guys have exposure to over 1,000 different crypto companies and protocols, which is insane. And your educational background, I want to make a note of this because it was pretty important in my mind. You studied, you have 2 degrees. One is in information technology and the other is investment theory. So take me all the way back. How did you get intrigued by those 2 topics?
Great. Well, thanks, Andrew. I'm very excited to be here. That's kind of my DNA. That's the things I'm interested in. I started studying investment or information technology. I loved programming when I was younger, but I was also intrigued with the global capital markets and the competition that's within that, and the theory behind that, and like things like option theory and all that. So those things came together for me during my studies. And I guess, maybe front running like your next question or something, but like this is making crypto feel like custom made for my DNA. You want me to go a little bit into how the Theta background and
Well, I love to hear kind of those topics and specifically around the coding. That is why did that specifically attract you? Because investing, I can see how that's broadly applicable to so many different fields, but coding, I think before we were not on this pod, but we had another conversation. You mentioned your first computer was like a Commodore, and it didn't even you couldn't even, there was no internet on it, right? And so you were really early interested in this kind of stuff. So how did that, where did that come from? Were you just naturally like, oh, I want to tinker and like build things, or what was that like?
I don't know. I think it's just how I'm wired. It's what's the right way to put that? Maybe the deterministic nature of computer programs. If it doesn't spit out a result, something is wrong, and you can always find the thing to fix it. I mean, similarly within like my economic study, I went to this investment theory, which is also more precise than broad macroeconomic questions that in the end, like, you can debate the answer until infinity. So it's what I liked when I was younger. When I was using my Commodore, I was mostly like creating little programs where I could ask questions and the computer would answer. I mean, that was the very simplistic start of it. But I've always combined these two things also in my professional career, right? So the first time I got interested in, I learned about blockchain technology. I mean, this was immediately my unlock. It's like, okay, now you get business models become programmable into the internet, right? So these 2 things immediately connect.
So after university, you decided to go into TradFi to kind of utilize your skill sets that you've been studying. And were you at a fund of funds, or which kind of firm were you at during that time?
So because I had my 2 master's degrees, I wanted to combine in one graduation thesis. I was looking specifically for that, and what I ended up doing was actually something that's quite a hot topic today. But I did my master thesis on creating basically a training an AI model to classify financial text for a financial product development company I was working for. So you had all these different specialists, and we would buy this information, and my AI model would have to classify that information to the different specialists. So it was based on the K nearest neighbor algorithm. So that was my first job. In that job, I immediately got involved with hedge funds. So we did searches for large Dutch pension funds that wanted to invest in hedge fund funds. So this is, how I first found out that was really something that that I liked, that I wanted those people's job, right? So I spent time on interest rate derivatives like asset liability questions for pension funds, liability matching, etc. But fairly quickly, I made the jump to Theta Capital and started to invest in hedge funds.
And at Theta, that's where did you hear about crypto from a friend, or how did you figure out about crypto?
So I joined Theta close to 20 years ago now, and basically so the background of the company is that we invest in hedge funds, right? So we create portfolios of hedge funds. At some point, we were managing a pretty large fund of hedge funds. We then sold those and continued with purely bespoke hedge fund mandates. And that was a time in 2012 when I really continued Theta and started, I guess, its second life. And then after a couple of years in 2017, I mean, one of my best friends was poking me, on and off with, what do you think of this Bitcoin thing? And I dismissed it until I, at some point, felt the urge to see how it actually worked, right? So this was, end 2016, early 17, really starting to dig into the technology, or dig into the whole system of how Bitcoin works, and how can you be sure there's nobody there that can have a backdoor and take all the money, and so, or change transactions. And so I mean, that really was my first iteration of understanding this technology. It took at Felton's course at Princeton, Bitcoin and cryptocurrency or something, to really take me through that, how it technically worked and how you could be comfortable that was tamper proof, right? So the way I think back at the period is, it's like going through your individual Gartner hype cycle several times. And first it was this technical question, and then there was other questions, and going from, okay, this can solve everything, to, oh no, this is never going to work, and back and forth. But it was in the 17 time frame that I, when I really dug into, really understood how Bitcoin as a system worked. And then Ethereum at the time, of course, was also a thing, and you saw the first applications built on Ethereum. This was the unlock for me. Okay, this was very clear. Okay, we are now, as I said before, we're now we can now program business models natively into the internet, right? And with that, you can get rid of all these boundaries and limitations that we're dealing with day to day with all the intermediaries we work with that constrain physically and in many ways, right? So I mean, one of my views is, okay, I've always felt also on the hedge fund side, the nerds are taking over the world, right? It's like the quants that become more and more important, and now the nerds really have superpowers, because now I can literally program any business logic into the internet. And the next step of that was, I got really excited about this. I really, it's also a very natural evolution of technology. It's really these new type of protocols, this new architecture that makes this possible, right? It simply couldn't exist 10 years ago because different components of the technology were not there yet. So it also felt like a very natural evolution. And what I did is I went to speak with all the hedge fund managers, right? We work with, because these are the smartest people in the room, right? They run internet funds and software funds, etc. But it was very clear that basically none of the traditional hedge funds had really looked into this, or this is what they would admit, right? We haven't really spent the time in understanding this technology. And by the way, it may be interesting, but what does that even mean, right? To invest in a protocol and rather than a centralized company. So we're not set up for that. So it was very clear from that day that, not only was there a massive opportunity for value creation by a new technology and a whole new unlock, but also a very contrarian investment opportunity, right? So from that day, and it's still the case to date. Basically, all the funding for what's being built in this sector is coming from this new group of VCs that we've come to call crypto native VCs.
So, okay, so this was in what, 17, 18, or what kind of year was this? And yeah, I mean, you got really excited, and you kept saying kind of you can program business models native to the internet. That is incredible. And so you're like, okay, well, I'm pretty well positioned to make some moves in this space. What was that initial move? How were you like, okay, well, I have this platform. We are involved with hedge fund guys. They're not really doing it, but I do want to get access to this ecosystem. What was that first investment?
It's those two things coming together: the investment opportunity, and then the like really the big unlock that we were seeing, and then the fact that only a very small group of investors in the world will focus at this. And I think what's interesting, like if you look at crypto native VCs, they were non-existent basically largely before that time, right? So the first ones really date from 2015, 2016. So in 17 there was a handful. So what I did was I got to know the specialized firms, and I started talking with our client base, like our investor base, that we were running hedge fund portfolios for, telling them that, listen, I think this is a very unique opportunity. The uniform answer, I think, from all of them at the time was, okay, listen, if it's investing in the blockchain technology, potentially interesting. If it's like speculating in cryptocurrency, not interested at all. But this is also, the interpretation I've always given our approach is like, we really invest in a new infrastructure shift that's gonna, I think, transform the global economy. So, this was in mid to the second part of 2017, and then you got the ICO boom. Prices started to run up, and of course, the last thing we wanted to do was to chase these liquid prices. So, our first investments were in January 18, and the way this became investable for us is that we had the opportunity to invest in a fresh vehicle of a US manager that they opened an offshore vehicle, but that didn't have any of these liquid assets yet. So that made the space investable for us. And then in 2018, of course, we got into that crypto winter, which we were very well protected against, given our entry, but also gave us the opportunity to continue to invest, build new relationships, and that's where it all started.
How was it convincing your existing LPs? Hey guys, crypto is a big opportunity. We need to do it. I found a guy. I found this US fund. Blah blah blah. Was that a really difficult conversation, or was that was it relatively easy?
I mean, it's a difficult conversation in the sense that basically nobody knows what you're talking about, right? So, but to be honest, I don't think it's has changed that much, right? So the way I approach it back then is still similar to the way I approach it right now, which is basically there's two components. So the second component is, okay, how important is this technology going to be in the long term? How much value does it generate? Where does that value accrue? What application areas will be the winners? What tech ecosystems will be the winners? These are all difficult questions to answer up front, right? And the thing is, in this time period that we are in, I don't think you have to be too opinionated on all that, because you can position for it in a very advantageous way, right? So what's much easier to understand for investors that don't really have a strong view on the technology is it is, it is very complex. It is completely new. There's clearly a group of investors that really have strong views and understanding of what's going on here, that understand what needs to be built next. Um, you know, by that time already, just looking at Bitcoin, Ethereum, and some other projects, it's also clear that there is a possibility for large outcomes, right? So I think it's focusing on that first part, like really explaining, why there's such a inefficiency in that market, like and I mean basically the way we look at it and the way we describe it, there's a stack of structural advantages that basically work in favor of these early VCs that I I can go in now or later.
So in the early days, because your background was in hedge funds, but crypto is this weird beast where it's a little bit of venture, a little bit of hedge fund, and because you have liquid tokens, you have equity. What was your approach? Were you like, okay, we want to find the best crypto fund managers, or we want to find the best crypto VC managers? What was that? What was that looking like?
Well, so where we're coming very clearly from the point of view that we believe this technology is that's the investment opportunity, right? Um, it's the biggest economic transformation I think the world has ever seen, like moving away from trusted centralized intermediaries to now frictionless global 24/7 internet business models, protocols, right? So and it's all completely new, right? So but the starting point is we want to invest in this technology. So question two is how are you going to do that? Well, um, everything here is completely new, right? This technology didn't exist. Everything has to be built from scratch. So VC is the logical way, right? Also, secondly, everything that's being built here is being built by startups, which is another super interesting concept, right? You cannot, if you're a centralized incumbent, you cannot reinvent yourself as a blockchain network because it would effectively mean you dissolving yourself, right? So 100% is being built by startups. Everything needs to be built. So it's very clear that we want to go the VC route. Well, how do you do that? Well, to me, it was, it was maybe partially because we were used to investing in funds, right? But overall, it was very obvious. Like this technology is gonna touch lots of areas. It's gonna evolve over time. It's gonna broaden out. So if you really want to invest across the areas that are going to be impacted by it, and you want to invest early and find the next things that need to be built, you have to work with specialized groups, right? And you have to, um, yeah, this is in the end what we try to achieve is to get early stage ownership in the most important blockchain networks that are being built across application areas, across like technology ecosystems. So that's how we got to the fund of funds, right? And I think coming from a fund of funds background, what's very clear, like it's a very big difference in this new industry compared to the hedge fund side, where it's, of course, there's edge you have, like in terms of access and being able to analyze managers, but on the blockchain side, you're not only bringing a lot of diversification over GPs, over the different areas that the technology is touching, but you, as a fund of fund, you can also add a lot of value, right? Like you can, we buy lots of secondary LP stakes, for example, where we buy portfolios that we know on a look-through basis at very attractive prices. We are able to negotiate with our managers, given that we're large and long-term partners. We can get fee discounts. We can get like special share classes, right? So for me, it's there was also very clear that we can actually where maybe traditionally fund of funds have been seen as a bit extractive for an end investor. Here you can actually, on a net basis, add a lot of value. And in terms of those, because of course one part of the question is why not invest in liquid or why invest in VC, right? There's this stack of structural advantages that I refer to, right? So if you're a VC and you know what needs to be built, the entry values are still pretty attractive, right? And part of that is if you're a founder that builds a decentralized protocol, you cannot hold on to the full ownership of it by definition. You have to distribute ownership, right? So what founders do is early on they look for partners that understand what they're building, that can help them on a technical level, on launching a network, but also, very importantly, that send a signal to the world, right? That to all these builders out there, that, hey, this piece of technology is the real deal. So, and this is what we see in practice, is when after 2 years after a seed investment, the blockchain network is being launched, there often is a whole ecosystem of builders already around it. It's a permissionless world, right? Like anyone can build on top of it. So that's a massive advantage. Like you being invested, like these VCs invest early, but they're also for a decent part masters of their own destiny in that sense, right? And then the second part is, not only can you invest at attractive early valuations, but the outcomes potentially can be so much bigger because the initial investments are being made, then the network effects start going, and there's literally no limit to how large things can get, right? There's no, these are public internet protocols, and there's many examples already where things really get in the tens of billions or hundreds of billions even, and let's say in general, I think blockchain networks, if in the future, if you compare them to like centralized businesses, they can be orders of magnitude larger, right? So attractive entry, larger outcomes. There's another element that's very much in favor of the VC route, which is it's not very capital intensive. So what we see is our loss ratio. Even if we look back to like 2018, like the write-off ratio of underlying investments on a look-through basis, right? It's single-digit percentage, right? And my explanation of that is crypto is, probably has the most pivots of any industry, right? If you're building something, if you're building a solution, it can be a certain ecosystem, and then that ecosystem starts getting less developer mindshare, you move to another ecosystem. When you build something adjacent, or like lots of successful crypto teams have pivoted throughout their lives, and you can do that because it's it's not very capital intensive to build something. And then another one to add on top of that is like the early liquidity, right? So if we look at VC investing here, it takes on average 2 years from the seed investment before there is a blockchain network, which by definition has then a token economy and a liquid token. And then 1 more year in terms of a lockup before there's initial liquidity. So this is completely different from traditional VC, where basically, after about 3.5 years, we see the initial liquidity. So this is what we call this is a stack of structural advantages, and that will erode over time, right? But like things will get more efficient. But maybe the biggest surprise to me is it's still very much there. We've seen people enter, like, let's say traditional VCs enter this market in 2021, making lots of the wrong choices back then, and they're completely gone again. So if we look today, still 95% of all the quality deals in crypto, like early stage private deals, are being done by crypto VCs. So for me, it's very obvious, and because all of this, what it results in is there's a very big value increase from like an early stage seed round to a network launch, right? And that's only when liquid investors can come aboard.
So there's all these incredible structural market advantages, and that this technology is going to be world changing, and like when I think about your guys' strategy, or I guess my question to you is, what is the overarching philosophy or investment thesis around Theta? Because it's like there's all these crazy advantages. You guys have the access. You guys know you guys know the fund of funds model. Like there's so many things in your favor. So how do you play this market? What's your overall philosophy?
You could say we operate as a generalist blockchain VC, right? This is we really research the space. Where does the technology make sense? And we kind of create a map, like the blockchain landscape. So what technology ecosystems, right? With that I mean like Ethereum, Solana, etc. Which ones have developer traction? What application areas like gaming, social, DeFi, etc. come into play? What happens in different geographies around the world? What different things? So we create this fairly objective map of what are all the areas on the map where we think we see a path to a lot of value creation. And then what we do is, basically in 2017, the one thing we very consciously decided is we want to be the very best in knowing all the crypto VCs in the world and what they're good at. And, so, and I think we build a very unique like database and knowledge graph there. So we create this landscape, and then we want to get early stage ownership in all these areas. That's in the end what we kind of operate on a look through basis, right? We want to invest in this technology, but we do it with early stage VCs. So you have gaming focused VCs, you have Solana focused VCs, you have people in Asia that are focusing on different things than people in the US or VCs in the US. So basically the first layer of how we construct a portfolio are generally smaller VCs, let's say average of maybe 50 million, that make seed stage investments in the 15 to 35 million fully diluted valuation range. And that gives us early stage ownership to all the high quality projects across the whole map. And then we work with some of the somewhat larger funds where we know, these guys will be in a position to lead the Series A of things that break out in this category and in that category, right? So that allows us to increase ownership in things that really break out.
So how do you think about manager selection? Because especially in the early days, it was really difficult to determine like who actually knew what they were talking about. Because I mean, back when I was around then, I thought, oh my gosh, this manager is so smart and so amazing, and their fund would maybe not perform well. And then alternatively, I thought other people's thoughts. I was like, oh, that makes no sense, and their fund performed extremely well. And then that was back in like the 17, 18 era. Things have, I think, evolved now, and you have track records and whatnot. But early on, how are you looking at manager selection? Has that evolved since those early days?
I mean, the core hasn't evolved of like, I think, especially in crypto, the number one thing you want to look for is people like it's authentic vision on the technology and wanting to invest for the long term and create a sustainable business of investing for the long term, because there's so many shortcuts you can take in crypto that in the end I'm convinced don't pay off, right? Like that's so that already it gives you a very important shift of managers you would look at and you would not look at. And I think being in the space and like really internalizing the technology and having a pretty crypto native team, etc. That kind of comes natural to us, I would say. What we look for is people that can then invest with conviction, right? And I think maybe the most important thing in investing overall is if you have conviction that allows you to be contrarian, which in the end is where you get like the most outsized investment results. So it's conviction, it's discipline in size, right? Really getting all of our dollars into that sweet spot of the valuation range. And that, is what I call fund math, right? And that can easily get out of hand. I mean, if there's many funds that invest half their fund in later stage things at very high valuations. And that makes a very big difference to getting all our dollars into the, early stage valuation category. But and maybe one underappreciated aspect in this sector, because lots of these fund managers are technologists, like the geeks for a good part, right? Like ourselves. It really makes a difference if you also have to be a money manager, right? You have like a money maker. You have to be able to move out of positions if the facts change, right? And not get married to the narrative, etc. So clearly early on, I mean, if you think about crypto early on, 17, 18, 19, investing, the whole thing was all still extremely contrarian. I think it's still very contrarian, but then it was extremely contrarian. So that also results in some funds that maybe don't check all your boxes to still do extremely good because they just were in the right space at the right time and hit some good outcomes. But what has changed over time, of course, it is maturing, although much slower than I would have expected. So that's great for investors. There's more and more new areas, right? So scaling unlocks gaming, unlocks social, etc. Regulations, new assets coming on board, unlock like parts of DeFi, and there's all these constant. There's this constant broadening of where the technology is relevant. So no single VC can claim to invest in all these areas and know exactly what needs to be built there and there. So you get more and more specialization. So this has definitely changed in how we invest, is where over time we get more and more granular in how we match VCs to our blockchain map.
What is your diligence process like for managers? Is it just, tons of references, lots of calls, and really getting to know them on a personal level? Is it more quantitative? Is it a mixture? Like how is that diligence process?
Yeah, no, it's definitely a mixture. I mean, we basically see all the managers given our starting point, and everybody, all our other managers know that we're looking for young new managers, and so we get all the introductions. We look at all the new deals that are done in the space, and we'll see when new managers that we don't know like are leading a deal and get to know them. So that's an important step one. Spending time with them and understanding how they think about my previous point, being there for the long term, making long-term decisions, setting the firm up for a sustainable success. And clearly, you have to. There's the whole operational aspects of it, which we are very used to, given that we've been investing in hedge funds. From the days that hedge funds were like very adventurous and new, and you had lots of opportunists, etc. So I would say that's a given. Like you do all the research in the structure and the people, etc. But for us, the crux is understanding what the edges of like what part of the map does this team, is this team very well positioned to really understand what needs to be built next? What do they have to offer to founders? What is the signal they have to offer to the broader builder community? And then, even with that, if you still have managers that different managers that qualify, but then fund math comes into place, right? Like if we invest with this manager versus that manager, where do our dollars really end up at the stage where we want to do it. So that's another layer that makes a real difference.
Tokens versus equity. What do you think and feel there? Obviously, you mentioned how advantageous it is for tokens to have that early liquidity, but would you invest in a manager that says, "Hey, I'm purely going to do equity," or maybe a manager that says, "I'm purely going to do tokens"?
Sure, we could. I mean, the evolution has been. I remember the first deck we put out. We said we expect 60% networks, 40% equity. It turned out to be more 75-25 maybe. So 75 networks. And let's see. I mean, it could swing back over time, but the real big unlock, the real like asymmetry is in networks. I believe that these where you have these unique network effects, and you can build something with a relatively small upfront investment that then becomes this massively fee generating, revenue generating global network. But again, I mean, if there's a very demonstrable edge that someone has that gives us exposure to just equity for whatever reason, right? Like we can work with that. I mean, the nice thing about being a fund of funds, I mean, this aside from like the diversification and covering the whole map, is you're a bit removed from all the craziness day to day and closing the next term sheet, etc. It's so we can take a little bit more distance of where's the industry moving to, where do we have exposure, what areas should we specifically look to add on, and this plays into that. Like there's definitely equity businesses that cater for the blockchain industry that can really become very big businesses. I mean, we're early investors in all the exchanges, for example, like across the whole world, right? All the custodians, analytics companies. So there's definitely a place for that, and yeah, it's a different skill set, I guess, investing in networks or investing in equity. So it's pretty natural that you have that distinction between managers.
In your experience, have you seen a main correlate between like, okay, all the funds that correlate to success? Let's say like all these funds that have launched in 2019, they've all done very well, despite one being DPIN, which didn't exist back then, but DPIN, this one being DeFi, this one being NFT, this one being info, whatever. Or are the correlates to success more like subsector focused, or is it access based, or what are these correlates that you've discovered that are, oh man, these all trend towards success?
Well, I think it gets back to my previous point. It's like investing with conviction, with that being able to be contrarian, right? I think if you look at all the biggest outcomes, it's because managers made very contrarian bets, but based on very strong research, obviously. So successful contrarian bets. It's clear that fund size, like just if you do the math, like a $500 fund, you're never going to have a 50x on, right? So for us, I'd say probably, I mean, we invest with funds as small as sometimes $10 million, right? But of course, what you're looking for is someone like if you see has to be good enough to win the best project, so they tend to have a bit more assets, right? But I'd say probably the sweet spot is around $50-60 million, where they invest $1.5 million tickets at a $25 million valuation for 5% network ownership, something like that, right? So obviously, looking back, like this trends have worked well, so it's easy in hindsight to point to winners. But I think what the thing that sets you up to winning in the future is being very disciplined at getting that sweet spot exposure in areas that you identify that have a lot of potential. So I mean, for us, that's one of the key things is trying, investing early, working with smaller managers, is where our skill set also brings most added value, being able to underwrite them early on. And gives us more negotiation power in terms of the terms, etc. So it's very clear what we're looking for.
Yeah. Are you able to dig into, any of your activities in the, secondaries? You mentioned that you guys were active in buying up LP secondaries and you had great look through into those portfolios. And then I don't know if you mentioned GP stakes, but anyways, other activities that are not just fund of funds, a little outside of that.
Yeah, so there's a lot there, right? Because I kind of look at it as it's an additional layer of complexity that we're particularly well positioned for to capitalize on, right? The fund layer. So, and we have this background, like in on the hedge fund side of things, after the great financial crisis, the years thereafter, we invested lots of hedge fund side pockets that had Lehman claims, for example, right? So Lehman claims were a great investment after the crisis for distressed managers, but you could also buy them at another 50% discount through liquidating side pockets. So when Luna collapsed and all like the Terra stablecoin, pretty soon thereafter we sent messages to I think at least 50 VCs, of which we knew their portfolios, and say, hey, do you have any LPs that are defaulting because we're interested in taking over those shares potentially. So we did some deals then, but most people would say, well, we don't particularly like what you're offering. So, and then 6 months later, FTX happened, and everybody came back, and we were able to make attractive purchases. It all comes down to this inefficiency of the space, right? Because none of these LPs, like in general, like we find the LPs that are investing alongside us, the vast majority of them really don't have a strong idea of what's in the portfolio, right? So, and even that continues today, right? In terms of the secondaries, because groups that have exposure and that were not immediately under financial stress to sell them, but that kind of just want to move out over time because certain things change. They've been waiting for the market to improve a bit, and they are now coming out, right? So we're still making these type of investments at very deep discounts to where where the NAV is, or where, most importantly, where we think actually the value is. But yeah, I mean, that's one thing, right? But it really adds up. I mean, the best example is probably one investment like a substantial investment we've made. We negotiated down fees. We created a liquidity event. We then arranged for a transfer into a new vehicle when most of the old vehicles positions were liquid, into a new private vehicle. And if you add that all up, if we would have just invested our money day one and never took it out, we would have made a 5x return, and now we're at 15x for that investment, right? Wow. So there's just a lot you can do. Similarly, we look at buying assets from bankruptcy estates. They also often sit on LP stakes. Again, we're not interested because that's not where we can compete, as in direct secondary deals. That's where some of our managers are active. But on this, when there's an additional layer of complexity, there's a role for fund of funds to play.
Very cool. So you did mention that you were in the early days of hedge funds, which were considered these pretty kind of exotic investments back then. And then now going forward, you said that you're even still now surprised that there's still so much alpha within crypto. Even at this kind of later stage versus where we were in 2017, 18, et cetera. How do you think about alpha decay in crypto? Do you imagine that we have 10 more years, 20 more years, 30 more years of incredible returns? Or do you think that now with institutions kind of coming in, do you think the alpha is going to diminish greatly? Or what are your thoughts there?
I'm really surprised that, with all the conversations we have, right, people don't still have, not a lot of people have a real firm grip on what this technology means and what it could mean, right? And we, on the other hand, have this, this great outlook for it. So, and maybe we're delusional, and it all turns out another way. But what's very clear is it takes a lot of work for people to really wrap their head around this whole new paradigm where you can have a business model in a decentralized manner, right? It's so contrary to what we're used to. So I think that in itself, it continues to make it very contrarian in that sense. Like generalist investors are just not here. So competition is just within this contained group of crypto native VCs, and of course that ebbs and flows. I don't think they've been able to raise a lot of capital over the last few years, so it's relatively subdued. But the big picture I always go back to is, sure, the jury is out on how much, how much value will actually accrue to these technologies, and it's also very difficult to predict where in the stack. Just look at the Ethereum discussions these days, right? Is it the layer 1? Is it the layer 2? Is it the application? Is it completely different ecosystems? Is it? So that's all very difficult. But the unique thing is that you can. The one thing that I am very comfortable in saying is you can still position for all of this in a very risk managed way. Like we make the way I describe it in my hedge fund. What I was always looking for in investing in hedge funds is quality of return. So you don't want to make like one big bet and hope it goes well. No, you want to make all these super high quality but highly asymmetric bets. And I think from an investor's perspective, this is really the extremely unique thing about crypto. You can make all these super high quality asymmetric bets that give you a very attractive risk profile. Whatever, however it plays out, you can position for it in a very advantageous way. So, one parallel I draw from the hedge fund days, every couple of years you came across one of these trades, right? And at crypto, they're everywhere. So probably the best example for me is the short subprime trade, which we got on board on in early 2006, right? Where if you did the work, it was very clear that the risk reward in that trade, like spending a little bit of premium but having this massive upside, was very attractive, right? And I think there's an analogy there. The reason why that exists is you have the whole machine, like all the banks and the whole system is long this infrastructure of generating these mortgage-backed securities, right? Even people in the banks that kind of knew, okay, this is not sustainable, and to turn that machine around was practically impossible, right? So that created this very skewed risk reward, and it feels to me in crypto is a bit the same. Like the whole machine is centralized businesses, and it just takes time, and it takes examples for people to see how actually these new models, these decentralized models, can deliver better, fairer product, be more profitable, etc. So, it's only logical that, of course, over time there's alpha decay, right? I'd say I'm surprised how little of it I think we've seen, but that will change. And that's and that's always been clear to us, right? So in the beginning, if you look at a couple of years ago, it was also less. It was pretty clear which managers you had to work with, right? And if they were set up the right way, you got rid of the operational risks. They were making sensible investments, and they were thinking in the right way about this technology. You could almost not go wrong, right? So that will change over time, right? That has changed for a big part. So for us, it's always been clear, like, okay, we have to continue to step up our game, right? So build that intelligence about the sector of what works, what doesn't work, what are the the key success factors, build the database, build all these relationships, make capacity agreements with the very best managers so we can continue to invest in the future, et cetera, et cetera.
Very cool. All right. So I'm sure you'll have some war stories here, but can you describe a challenging moment that you've been involved with during your tenure at Theta?
I think there was a point in time when we already were investing in blockchain, right? So I'm talking I'd say early 2020. So we've made our investments in crypto VCs, and I was like feeling very upbeat about how that would play out, but there was very little to show for yet at that moment. So, and I was already, also starting to build a team, anticipating, more to do here. So this, like, it's, that was a time in that period, and it was just before DeFi summer that kind of started changing things, and the space really took off for the first time in that time window. But yeah, I mean, there was a moment I think in April of 2020 where I remember saying in our directors meeting, like, hey, listen, I think I'm going to take a big cut on my salary because otherwise we might not end up in the black this year, right? And I mean, it was not an existential a moment for the business, but that's probably the most dire it got. I think, tying back to previous questions, how this technology plays out is going to be super path dependent, right? You have regulations that play into it. You need technical unlocks, etc. So what becomes very important is how you structure your business around it, right? So we have 10-year funds. We don't we don't have redemption pressure when the cycle turns. So that puts us in a position to always be pro-cyclical, like, the other way around, like contrarian, right? Like step of the gas when others have to deal with redemptions and capital outflows, etc. But if, in that sense, it feels like within this wild sea of crypto, we're a beacon of what is it, calm or like. But sure, there's I mean, at that time, early 2020, we've only gone through a crypto winter, and we had expectations of the upside, but we hadn't seen it yet.
10 years from now, where do you want Theta to be?
Let's say, I think for me, the key broader picture is we're in this extremely extraordinary point in time, right? It's crypto, but it's also AI, it's also technologies, it's the whole singularity that we're getting closer and closer to. We're gonna see this massive transformation of the world in the years to come. I mean, I don't think there's much to argue against that, right? So where I feel very fortunate is that we now have a platform in a business that plays a role in one of the key developments, right? I really believe blockchain technology will be the backbone, it will be complete new backbone for the whole global activity, right? And we're gonna see global economy. So we're gonna see economic activity on a scale that we can't imagine, right? Frictionless 24/7, all these assets like AI agents using it, et cetera, et cetera. So that's my bigger picture thinking about the world. Like, okay, how do we, what role do we play here? So I think the investment strategy is very clear. We're not planning on any big changes there, just improving our game. One role that comes pretty natural to us is explaining what's going on here to outside traditional investors, right? So that's where we're building, also stepping up our research, or like storytelling of making explainable what we think will happen here. So yeah, I mean, the big goal is just to continue to, play some role in yeah, probably the most, I don't know, exciting, I don't know what's the right word, like, but most extraordinary period of like recent human memory, I guess, that we're going into. Um, it also feels to me like this. If you think about everything that will be changing, I mean, it's very difficult for me to see myself spending my time on anything else than trying to be at the forefront of this. But yeah, beyond that, having building a nice lean and mean team of people, continue to build on what we have, and keeping that technology vision as the forefront of our investment strategy, right? We want to keep investing in the things that are really going to change the world.
Amazing. Ruud, thank you. This has been incredible, but it's time for the closing questions. All right. What is a belief that you once held strongly, but have since changed your mind?
I guess one belief I held strongly, but where I'm surprised is that the world is such an efficient place, right? If we look at our hedge fund, it's very difficult to beat the market with a strategy. Like the world is so efficient and so connected. At the same time, I feel we're working now with one of the most transformational technologies the world has ever seen, and it's invisible to people, right? So there's a big disconnect between that, it seems. So yeah, that will be my answer.
Interesting. It's yeah. So what is that due from? Is that because it's like people are mimetic and they see that not everyone believes in this, therefore I don't believe in it? Or what is that? What is the reasoning behind that big difference?
What's happening, like one way I visualize it is that what's happening is almost too big for most people to see it, so you can't look around it. It's also, of course, there's so much noise, so you can't see the forest for the trees. Like, but yeah, I mean, it just turns out, and it's a very fundamental shift in thinking, right? Every conversation I have with entrepreneurs, with traditional investors, is okay. You know, how does this gonna change what I'm doing, like today in my business? And it's the wrong question. It's like it's you cannot apply blockchain technology in your business to make things more efficient, right? Which is the way we think about technology, which is the way you think about AI. But this is a complete new way of doing things that we're not used to. Although from the outside, you could argue we've had like the email and SMTP and HTTP, etc. So there's analogs, right? To me, like stable coins is perfect analog in this new world to what email was with the old internet protocol.
Very cool. All right. What has been the most defining moment of your career so far?
Doing the Princeton, like at Felton's crypto blockchain course, like really, because there's so much, everything happens in the open, right? And all these resources are out there and podcasts and stuff to read, but like a structured way that goes from private public keys to all the elements that make up blockchain networks, that understanding that gave me the conviction to completely focus on the space. And so I guess that's the one.
Very cool. All right. You could go back in time and give yourself one piece of advice before starting, your whole career at Theta and your whole blockchain career. What would that piece of advice be?
Probably the piece of advice we now give to founders, which is like, do everything, take long-term decisions, right? Especially take the right long-term decisions all the time. So especially, I mean, and there's different elements to that, right? If you're starting to build your business, you're tempted to go for quick wins, etc. Within crypto, that's even exacerbates that. I mean, there's so many like like there seems to be so much easy money, like buying this thing at a discount, etc. It turns out that's not how you create the long-term success. So this is what we like try to keep in mind every time, and we'd probably be in an even better place if we would have done that from day one, to just make long-term decisions.
Very
Or
cool.
decisions that are the right decisions for the long term.
All right. If you could sum up your life philosophy in a single sentence, what would it be?
Be open-minded.
Oh, I love it. I love it. Ruud, thank you so much. This has been incredible. Where can people find more about yourself and find more about Theta?
My social media presence is fairly non-existent. So you can send me an email. No, so we have a website, thetacapital.com. We have a weekly newsletter now where we kind of tell people what's going on in crypto, but in a understandable way. That's written by my partner John. So the easiest way to look for that is on LinkedIn, on the Theta Capital. And one thing we do every year, and you have been there a couple of years back, is our Legends for Legends conference, which we do every year in Amsterdam. The next one will be October 16th. And the idea there is raising capital for Alternatives for Children, which is the charity that my other partner here founded in 2011. But content-wise, it's bringing all the thought leaders of crypto in one room with 300 allocators and take them through what's going on in understandable language. So legendsforlegends.com, I think you can find more.
Amazing. Thank you, Ruud. Appreciate it.
Thank you so much.